Hello and Namaskar viewers, I am Sanjeev Pandya welcoming you to this week's episode of the Business Talk with Ajay right here on ITV Gold. The show is brought to you by CPA Services, a professional full-fledged accounting firm located in the state of New Jersey with multiple locations, and they can assist you with any tax related matters, tax audit matters. They can also help you with virtual CEO, virtual CFO. They can also take care of your bookkeeping matters, and they can also help you with the business valuation. They've been helping hundreds of thousands of individuals throughout the nation. Wherever you are in the country, you can give them a call at 908-380-6876 or visit their website cpsservices.com. As we are just getting ready to start this week's episode, let me just tell you that last week we started this series. It's called Business Valuation. That was a part 1. And today we're going to have a business valuation part 2 of 2. This is a 2-part series. And before we begin, I'd like to welcome Mr. Ajay Kumar, CPA and MBA with CPA Services for over 30 years. He guides us, he informs us, and he lets us know about the details on the businesses. So Ajay, welcome to the show.
Thank you, Sanjeevji.
You're very welcome. And I'd like you to begin. Let's begin with the summary of business valuation part 1, which we did last week.
Absolutely.
That how important the valuation is, and how valuation can be very helpful to the business owners.
Absolutely. So a business valuation essentially means how much you can get by selling this business. If you were to give this business to somebody else, how much you can get. So business valuation is extremely important, not if you're thinking about the exit strategy, but also how do you grow the business? How do you create an enterprise value for your business? A lot of people come to us for business valuation only when they need, when there is a shareholder dispute, when there is a will and estate, when there is trust planning, when there is divorce, when there is M&A happening. But I suggest to all my clients, think about the business valuation. Have the business valuation done every so often, every year, every 2 years, every 3 years. So you can focus on the variables, on the drivers that are used for business valuation, and you can consciously continue to work while you're growing the business. Focus on the variables that will help your business to get more value out of it.
Okay.
This is your baby. This is what you created. Make sure you get the maximum value out of it.
And it also helps when there is a new owner want to step in, and if there is a merger and acquisition.
Absolutely.
It helps that if you have business valuation done every year or every 2 years, right? That shows the sincerity of your
100%.
business, and that adds a lot of value to it. All right, so that was a part number 1 that we did it. Hope you watched it. And now let's go into the part number 2. With the part number 2 on a business valuation, let's begin with the conceptualization.
Absolutely. So in the part number 2, Sanjeevji, we want to cover the tools and techniques of this business valuation.
Right.
We told you why the business valuation is important. We told you where you need the business valuation done. Let's talk about some tools and techniques of the business valuation so you're aware of them. I'm not expecting you to be doing the business valuation yourself, but knowing how it's done will help you plan it properly. So at a high level, there are 4 types of business valuation techniques that we use. One technique that's typically used in the market is conceptualization, where we look at rule of thumb, business reference guide. The idea is all accounting practice are sold typically for 1 time of revenue. All grocery stores are sold for typically 5 times of EBITDA. So that rule of thumb, general, your business could be better, your business could be different. So not all accounting practices have the same margin or the same EBITDA. EBITDA is a way to measure the cash flow from the business. It's earning before interest, tax, depreciation, amortization. But what we are trying to get to is how much cash flow can I expect from this business? How much income, how much money can I expect by buying this business? In how many years I can recoup my money? If I were to give you $1 million, how many years is going to take me to recoup that money? That's one technique, conceptual, based on concept, based on general market standard. And that technique is referred as rule of thumb technique, conceptualization technique, or a business reference technique.
Okay, very interesting. Really like the detail on conceptual approach. What about income approach? How do you take care of that part?
Absolutely. So let's talk about the income approach. In the income approach, we take the net income that you are showing on the tax return. And again, as we discussed in our first episode, it's extremely important to show proper income. In the next buyer's eyes, your business is worth only based on the income it can generate. So it's very important to think about an exit strategy 2-3 years in advance so you can show proper income on your books, proper income on your tax return. What we are looking at it is we take the income, add back depreciation, amortization, add back non-cash items to see how much cash flow this business can generate, how long this business is growing, what's the percentage. So if this business keeps growing 5% every year, if I'm making $100 today, tomorrow, next year I'll make 105. The year next I'll make 110. How many years can it sustain? What's the inflation rate? In how many years can I recoup my money? After n number of years, I will have the right to sell it off. What money can I expect to get when I, as a buyer, sell off this business in the future? All this cash flow, income is added together and then discounted to the present value, because the money you want is now, not in 20 years. What can I give you now? What do I have to give you now? And based on the inflation, based on the growth rate, based on the terminal value, in how many years can I expect this money back? What's my rate of return on this income? This approach, in summary, is referred as income-based approach.
Very good. Okay, before we go to the next approach, a question I have for you.
Please.
Since you mentioned income and, basically you take the income of that business last year, 2 years, 3 years, and whatever it is it a truth or a myth that whatever your income is, let's say your income is net $1 million after all the expenses and tax and everything and EBITDA and everything, is it a truth or myth that your business is worth $3 million? Do they go 3 times your net income to make business worth? That's what I have read and heard somewhere.
Well, the short answer is a myth.
It's a myth.
The real answer, if you want to think about it, there are, let's say if you buy a building, $1 million building, the rent you're getting is only $10,000 a month. In the whole year, you got $120,000. Assuming no expense, no property tax, no association fees, no expense, would you sell this building for $360 to me?
No, absolutely not.
Then how could it be true? Take another example. The business, there are a lot of examples when the business is not making any income. Amazon.com, for the n number of years, there was no profit.
Correct.
They had huge infrastructure. Is the business worth nothing just because they have no income? So how could I be charging 3 times? There are certain businesses where the rule of thumb is used, where this grocery business will say 3 to 5 times of EBITDA.
Or IT business.
IT business could be 3 to 4 times
Correct.
of EBITDA.
Correct.
So any professional service business is typically valued based on EBITDA or net income or cash flow, and then we use n times. It could be 3 times, it could be 4 times. There was a time when IT companies were going 8 times of EBITDA.
Oh,
that's huge.
Really?
But in a professional service company, doctor's office, IT consulting companies, dentist office, all these companies based on cash flow. EBITDA is nothing but a measure of cash flow. So we look at the cash flow and then we use other factors, terminal value, discount value, growth rate, and then decide is it 2.5 times of EBITDA or 7.5 times of EBITDA.
Okay.
But a lot of times it's certain factor of EBITDA.
just wanted to clear the confusion.
Absolutely.
Since we're getting so much
But
detail
that
from you.
technique only works when you are measuring the value of the business based on income approach, in the sense based on EBITDA. There are a lot of situations when it's not possible to measure the value of the business based on EBITDA because there is no EBITDA. Either the income is negative or the income is not in proportion to the asset value.
But then if, let's say business is a convenience store, for example, or a motel, wherever most of South Asians are in there, right? And they're making so much money. Let's say they're making $100,000 at the end of the day. Now if they want to go sell the business, they say, listen, the business has a potential of making $200,000 a year. I tell you why. Because the prices of the products going to go up, while the expenses may remain the same because owner staff is on a salary is going to be perhaps the same. But the price is going to go up. Maybe in some products their margin will go up. So there is a room to go from 100,000 to 200 or maybe up to 300,000, correct?
Absolutely.
Okay.
So in that case, do you value the business based on the current income stream or do you value the business based on the future income stream?
Okay.
When you say 3 times multiple of income or EBITDA or cash flow, what is this 3 times multiplied by? Is it current income or is it the future income?
Correct.
What's the guarantee of this future income? What's the discount rate you want to use on this future income? Say, for example, Dunkin' Donut. was doing very well in winters. In summer, they were not doing as well. But they brought in this ice cream shop in there.
Yes.
And now the business is one of those cases, 1 + 1 is more than 2. Because now they have summer business, people who are coming in to get the ice cream, they are getting some cold smoothie as well.
Correct.
Some frozen
Yes,
smoothies as well.
absolutely.
So it created a synergy between the businesses. Then the business value has increased. So
Okay.
it's not always 3 times of
All
EBITDA.
right.
In many, there are businesses where it can be 3 times of EBITDA, 3 times of cash flow, but in most cases, this is not how you want to value the business.
Okay. All right, good. Now let's go and look in a market approach, because market approach is one of the key elements in a business valuation report.
Absolutely. Again, depending on the type of business, in many cases, it doesn't matter what you say. It doesn't matter how much assets you have. It doesn't matter what income stream you have. In the market, everybody else is selling 3 times of EBITDA. So you sell it for 3 times of EBITDA. Look at the typically your housing market. How much is the cash flow? There is no cash flow. I have 3 houses. How much can I sell it for? How much is your net income? Zero. Your business, your 3 houses are worth 0. Somebody told me 3 times of EBITDA, 3 times of net income. Is that how it's going to work out? You say the market value. How much is this house being sold, or similar houses are being sold in the market? So essentially, if you extend the same housing concept to the business concept, there are databases like Realtor.com for the housing. There are databases, BizComp is one of them, IVA is another database. These databases take information from all the market for all type of businesses. They have thousands of businesses in there, recent transaction, all the transactions. So what you do, you go to the database, you have to subscribe for it, or the accountants will have access to it. You go to these databases, look at the database, see that my industry code is this, my business type is this, my size is this. So based on several factors, you try to create a subset of the businesses that were sold recently in last 1 to 3 years that looks similar to the business that you are trying to sell.
Okay.
And then you see the market value approach, and then you try to take an average or discount. Oh, that business is 20 million. My business is 2 million. Is it good or bad? It could
Is
be
it
either.
is it just quickly?
Please.
You can answer just in a one word quickly. Is it one of those very important elements that the evaluator really have to work hard on the market approach things?
Well, a good valuator will work hard on all approaches.
I know
Doing the
that, but
income approach.
specifically market approach.
The trick with it's not working hard. It's working smartly. The trick with the value approach, when you look at the market valuation, is finding the similar.
Okay.
You can find a similar house, finding the exact same business with the same revenue, with the same location, with the same staff. How do you know your accounting practice does not have more competent staff than my practice?
Okay.
Then looking at the market approach, there are a lot of factors that you wouldn't know. So finding the right comparison is the key when it comes to the market approach.
Very good. With that note, we're going to take a quick break, and when we come back, we got more coming your way regarding this business valuation part 2. Stay with us. Welcome back to the second half of the Business Talk with Ajay. Today's topic is business valuation. Very important. If you haven't had it done for your business till now, take a look into it. You should really have it done, because you never know when you're going to need it. You know, nobody stays in a business forever. Things change, circumstances change, you know, your obligations change, and that's when you want to bring in somebody, or you want to sell the entire business. Whatever it is, business valuation is very important. Whether you have a convenience store, whether you are owner of a motel, whether you have a dry cleaning or laundry shop or anything. Get the business valuation done, and at least know that how much is your business worth. And for that matter, or for any taxation matters for your business, or even personal tax matters, you can contact Sai CPA Services, which proudly sponsors this show, The Business Talk with Ajay on ITV Gold. Sai CPA Services can assist you in any tax related or the business related matters. Give them a call at 908-380-6876 or visit their website saicpaservices.com. As we're getting all this, valuable information about business valuation after the income approach and after the market approach, now let's look into asset-based approach, how many assets your business has and how they are valued in the report.
Absolutely. Very well said, Sanjeevji. I will add, even if you think you will run the business forever, it's still important for you to know the drivers, the variables that can help you create an enterprise value in this business, increase this business substantially. So let's look at the asset approach. We talked about the conceptual approach, the rule of thumb approach. We talked about the income approach. We talked about the market value approach. Now we are looking at the asset value approach. In asset value approach, what we are looking at is a company that's asset heavy. And what would that be? A real estate company, for example. A real estate company has this commercial property, 10 shops, $10 million property. The rent is only $20,000 a month. So when you have $20,000 a month and you have $250,000 of rent, is it $750,000, 3 times of EBITDA? Or is it $1 million, 4 times of EBITDA? How do you calculate this company that owns this strip mall worth $10 million that you paid for, while the rent is only $250,000? It's 40 times of EBITDA. Is that how it works? No. In that case, we look at the asset value approach. We look at each asset, we divide this asset. In many cases, the company has multiple assets of different type: commercial asset, residential asset, some assets in different geographical location, New York-based assets. So you can't really use this approach in general for all the assets together. You have to separate these assets out in certain groups, then have independent valuation done in many cases of these assets. In some cases, the assets are not as easy to value. For example, you have a customer list. I have 2,500 customers that I do taxes, bookkeeping, payroll, and whatever for. Do this list of customers has some value? If you have another accountant who will be willing to pay a lot of money for that list of 2,500 customers, but how do you value that list? That's covered in the asset value approach, where we are not looking at the cash flow being generated by the business, where we are not looking at how other businesses are sold in the market. We are not looking at the income approach. We are not looking at the market comparable approach. Here we are looking at the asset approach, where we divide these assets into multiple categories and then try to value each asset separately and then sum it up to see this is the value of your business.
Very well, interesting. Now, a question comes to my mind.
Please.
You know how that we come to terms, and we refer to the terms in any businesses, that this employee is an asset to the business.
Absolutely.
And this employee is a liability to the business. So in some businesses, there are some employees who are definitely asset to the business. One, because they have been there for a number of years. Second, they are very diligent, very accurate, and they are very, very serious about their job and everything. And if that employee decides to stay in that business, if ownership changes, does that employee's asset part also comes in effect in evaluation?
Absolutely, it does. Not directly, indirectly. In the sense, exact same size of company, in the exact same industry, with the same revenue, same profit. One company has employees that have been there for 10 plus years. Another company has same number of employees, but these employees have been shuffling, turning over, and all these employees are less than 1 year in the duration, less than 1 year in the company. For which company you will pay more? Same revenue, same profit, same income, same size, same number of employees. This company has employees that have been there for more than 10 years, all of them, 10 employees, more than 10 years. This company has all the employees, 10 employees, less than 1 year. You decide.
Okay. All right, so it does come in effect. Anyway, so with the tools and techniques, in the end, let's say if you have anything else to cover.
Absolutely. So we covered the techniques at a high level. There are 4 techniques that we are looking at. Now, each technique will have its own tools. So when we look at the first approach, conceptual approach, is rule of thumb approach. There are business reference guides available in the market that talks about each business by geographical location, by size of the business, and gives you some rule of thumb approach, conceptual approach, as this IT consulting company under $3 million in the state of New Jersey is worth 3 times of EBITDA. So there are some reference guides around conceptual approach. Similarly, when we look at the tools for the income approach, we are typically looking at either the capital asset pricing model, we call it CAPM, or we are looking at the discounted cash flow model, depending on situation to situation, if it's a linear growth or if it's non-linear growth, meaning if the growth is consistent, as opposed to 1 year is very high, 1 year is not there, or the business is losing money. In those cases, we typically use discounted cash flow model. Then in the market approach model, we'll have another tool We talked about BizComp, we talked about IBA, then there are PratStat. There are a lot of tools, databases that will have the company information in there. Say, for example, BizComp will have 11,000 plus companies recently sold. So you can look at that database like Realtor.com to see house sold in my neighborhood under this price. Similarly, those type of databases will give you that information. So that tool, those databases are used for market approach. Similarly, there are tools, adjusted asset value that we use in the asset based approach, meaning you bought the property for $10 million, but it was purchased 50 years ago. There is a different market value now. You have done a lot of improvements to this property. Now, a lot of depreciation has happened. There's aging that's showing up. So there are a lot of tools around asset-based approach. In summary, when we talk about 4 valuation technique, conceptual model, income approach, market approach, asset approach, each technique will have own tools and trends that we have to look at.
Very well for the information.
Please understand, all business valuations must consider 3 different type of business valuation.
Yes.
You cannot say 3 times of EBITDA.
No.
This is the business value.
Correct.
You have to consider 3 different type of business valuation approach in order to come up with a value.
All right. Now the last question. We only have 1 minute. Maybe last question. 1 or 2 word answer. When they go for business valuation, who should they go? The licensed business valuator that they should have. Is that the one thing to look for it? And how much normal does a business valuation report cost?
Absolutely. I'm glad you asked. It's one of those things. When you go for your taxes, do you look for a CPA who has the license, or do you want to go somebody who is not a CPA and just doing it, or do you want to do it yourself? Same thing comes to business valuation. You want to find somebody who knows what they're doing, who have done it in the past. Ask them what experience you have, what licenses do you have, are you certified in this field for doing the business valuation?
Correct. That is the key thing, certified with
Absolutely,
the license.
absolutely. A business valuation, depending on the size of the business, depending on the industry, depending on the purpose. If it includes the litigation, if the valuation expert is expected to go to court to give the testimony,
correct,
that wastes the whole day.
Correct.
So depending on the size of the business, revenue, depending on the industry, depending on the purpose, the valuation prices could be different. It could be as low as $3,000. It could be as high as $10,000. But somebody who is charging much less than the market price, don't go there.
Okay.
You don't have to be finding the highest price, but don't go for the cheapest price either.
All right. With that note, we come to an end of this week's episode. Remember, for the right service, whether it's a tax or business valuation or investment advice or any bookkeeping services, you go to right place, and that's a Science CPA Services. We thank Science CPA Services for sponsoring the show. They can be reached at 908-380-6876. You will see it on the screen. ScienceCPAServices.com is the website. Ajay, once again, thank you so very much. I am Sanjeev Pandya, wishing you all happy and valuable days ahead. Until we meet again, same place, same time. So long.
Thank you.